The U.S. government has amassed multi-trillion-dollar debt obligations that cannot be sustained indefinitely. And it's going to force U.S. income tax rates to skyrocket. And that's why getting your money into the tax-free zone right now, not later, is so crucial. Brian Riedl from the Manhattan Institute joins me right after this. Welcome to ETFguide TV. I'm DeLegge. Great to have you with us. Today's conversation is going to be about the massive and unsustainable government debt, why skyrocketing income tax rates are ahead, and how to protect yourself. Now, before we go any further, don't forget to watch our lineup of original episodes like ETF Battles and our newest edition, First Look ETF. Links are provided in the description section below. And after you subscribe to ETFguide TV, these episodes will automatically hit your email inbox, so be sure to flip on your notifications. I'm pleased to introduce Brian Riedl. He's a senior fellow at the Manhattan Institute, focusing on budget, tax, and economic policy. He worked at the Heritage Foundation for a number of years. He served as chief economist to Senator Rob Portman and as staff director of the Senate Finance Subcommittee on Fiscal Responsibility and Economic Growth. In other words, he knows what he's talking about. So, Brian, welcome to the program. It's great to have you with us.
Glad to be here. Thank you.
Let's begin with COVID-19, which is still in the global headlines. And I want to talk to you about this from the angle of the U.S. government's spending tied to it, which has accelerated government debt and budget deficits. So can you give us an update on how much of a financial burden COVID-19 has become?
Sure. Before COVID hit, the national debt held by the public, the amount that had been borrowed from people, was about $17 trillion. Because of COVID, we've already borrowed $7 trillion more. So that by itself has caused about a 40% increase in the national debt compared to everything we've ever borrowed in American history up until this point.
That's pretty incredible. Now, even before COVID-19, the U.S. government had an overspending problem. You know that. We know that. Any observer knows that. So we've got Medicare along with Social Security, which are the chief culprits. So how bad is it?
It's worse than people think. Because of trust fund accounting, people don't realize how out of control the deficits for these programs are. This year alone, Social Security and Medicare will run a $600 billion cash shortfall. That shortfall is going to rise to $1.5 trillion per year in a decade. And over 30 years, Social Security and Medicare face a $101 trillion cash shortfall. Let me repeat that, $101 trillion. The rest of the budget is actually roughly balanced over 30 years. The fact that we're going to have a $100 trillion deficit over the next 30 years is because Social Security and Medicare are going to run a $101 trillion shortfall over the next 30 years.
Those are some gigantous numbers. Now, you mentioned headline, debt at $29 trillion, almost there. I'm not sure if we've reached it, but we will if we haven't already. So how accurate is that number? Because like you alluded to, it emits a lot of these massive multi-trillion dollar liabilities that are tied to Medicare and Social Security, which aren't included in that figure. Wouldn't it be more accurate to start including Medicare and Social Security liabilities to the national debt figures?
There's different measures of debt. $23 trillion is the amount we've actually borrowed from the financial markets right now, $23 trillion. If you add intergovernmental debt, we're at $29 trillion. That's the Social Security Trust Fund and the amount that we've already rated from trust funds and Social Security and Medicare that we have to pay back. So our obligations get us up to $29 trillion. But if you really want to go into the whole amount we really owe Social Security and Medicare over 30 years, if you assume, as most people do, that regardless of what happens to the trust fund, we're not just going to stop paying benefits, when the trust fund goes to zero. Over 30 years, like I said, $100 trillion is the shortfall. So our measure of indebtedness really depends on what you consider debt. The amount we've already borrowed, the amount that we're on the hook for trust funds, or the amount we're on the hook just to pay full benefits over the next 30 years. So you can go anywhere from $23 trillion to $123 trillion, depending on which definition you use.
Yeah, well, any way you look at it, it's a lot of bananas. By the way, I mean, how do you add up all these numbers? What kind of calculator are you using? Because I hope it's not like an iPhone calculator, because the numbers don't go that big.
We're past calculators into Excel spreadsheets that are made really wide to incorporate huge numbers.
In a recent interview on ETFguide TV, I spoke with David Walker, who I know that you know, former Comptroller General of the U.S. government, head of GAO. And he told me point blank, listen, Ron, income tax rates are going up significantly, and current income tax rates here in the U.S. are never going to be lower than they are right now in our lifetimes. What do you think about that?
The former comptroller is absolutely right. Ultimately, I think we're going to need to rein in spending. You cannot raise taxes enough in order to close a $100 trillion shortfall. It's mathematically impossible to do it through tax hikes. But we're not going to do it all on spending reforms either. And so there's going to be some mixture of new taxes and spending cuts. You know, just to show you what we're talking about, it would take an 18 percentage point increase in across the board in income tax rates or payroll tax rates to pay for Social Security and Medicare. So the 15% bracket would need to become a 33% bracket. A 37% bracket would need to become a 55% bracket. You would need to raise income tax rates 18% across the board. Or we keep hearing about a value-added tax, which is essentially a national sales tax. You would need a 35% value-added tax to pay for all the spending in the pipeline. Ultimately, I don't think we're going to go that high, because that assumes that there's no spending reforms. I hope we don't go that high, but that's what it would take. It's almost impossible to maintain our federal budget outlook with taxes at our current level, even if we're aggressive reining in spending. So I would prepare at some point to have pretty steep tax hikes.
And people that say, well, listen, you know, doing a double, you know, going from 15 to 33 and then from 37 to 55. I mean, that's crazy. That will never happen. And all you have to do is look at history. People forget that, you know, history is riddled with examples of higher tax rates in the past. For example, the 70s, we had a 70% tax rate at the top end. Even before that, it was much higher, 91% in the mid 50s up to early 60s. So if future income tax rates are headed substantially higher, and I believe they are, you believe they are, how high do you think, again, it would have to go to fix the government's financial mess?
The left will tell you we can do it by taxing the rich, and that don't worry, the middle class isn't going to be hit. I've run the numbers. You could do every tax the rich hike, from FICA taxes all the way up, the Bernie Sanders estate tax, the 8% wealth tax, capital gains taxes of 40%, carbon tax. You wouldn't even balance today's budget, much less future liabilities. So ultimately, the middle class is going to get hit. Again, I don't think that they'd actually double income tax rates because I don't think that that's politically possible. But it's going to go up maybe 5-10 points. And, you know, people say, well, that's impossible. It'll happen gradually. You know, that's the way it happened in the U.S. after around the time of World War I, where we went from having no income tax to having a 63% top tax rate. The way it happened in Europe, it's gradual. 1 point here, 2 points there, 3 points there. But ultimately, again, $100 trillion cash shortfall, it's almost impossible to close that gap without moving taxes at all, as much as I wish we could. So I think, you know, again, I think the way this ends is with income tax rates maybe 5 or 8% higher and a value-added tax of 15 or 20% at a certain point.
We're going to have to leave it there. Brian, thank you so much for sharing your insights. I look forward to catching up with you soon. Keep up the good work.
Thank you very much.
That was Brian Riedl with the Manhattan Institute. I'm Ron DeLegge with ETFguide TV. Thanks for watching. We'll see you next time.